Here is the brutal truth most traders never recover from. Nicholas Darvas didn't make millions by being right. He made millions by refusing to act like an amateur. Amateurs believe trading is about intelligence, speed, and clever predictions. Professionals know trading is about survival under uncertainty, managing risk before thinking about reward. Darvas was a dancer, not a financier. He had no access to Wall Street, no real-time screens, no privileged information, and no powerful network whispering tips. Yet he turned roughly $10,000 into more than $2 million. That outcome wasn't luck. It was pain converted into structure. Early trades destroyed him. He chased stories that sounded convincing. He increased position size emotionally after small wins. He ignored stop-loss levels because fear/greed always found a logical excuse. When trades went against him, he didn't act. He hoped. Hope became his most expensive habit. One trade finally broke his ego completely. He bought a stock making new highs, confident he understood the move. Shortly after entry, price dipped slightly. Nothing dramatic. Just enough to trigger discomfort. He froze. He told himself it was normal. He waited. That small loss became large damage. The money hurt, but the realization hurt more. That pain forced a professional question most traders avoid. Where is my risk defined, and why wasn't it? That single question birthed the Darvas discipline. Amateurs ask, how much can I make if this works? Professionals ask, how much can I lose and still trade tomorrow? Darvas realized the market doesn't care about effort, intelligence, or desire. The market only responds to behavior. So he stopped predicting outcomes. He started demanding confirmation from the tape. He refused to act until price reached a pivotal point that justified risk. This is where the identity split becomes permanent. Amateurs want action. Professionals want clarity. Darvas waited for price to prove itself before committing capital. He defined his stop-loss before entering, not after emotions arrived. He reduced position size until losses felt boring instead of painful. Most importantly, he discovered a rule hidden in plain sight, one most traders still misunderstand today: waiting as a position. Doing nothing wasn't avoidance. It was active defense. It was a decision to protect capital and mental clarity. He learned that inactivity protects capital better than constant action. Patience became leverage. Every hour he didn't trade was an hour he didn't make a mistake. Every day he stayed out of bad setups preserved confidence for the right one. Pattern interrupt. The market rewards restraint, not effort. This insight alone separated Darvas from gamblers chasing stimulation. Waiting removed emotional noise. It weakened fear/greed before they could influence decisions. It forced discipline when excitement tempted shortcuts. This chapter opens two critical loops that define everything that follows. Why does waiting outperform constant activity, even in fast markets? And how did Darvas grow positions aggressively through pyramiding without increasing emotional risk or breaking discipline? Those answers reveal the real difference between gamblers and operators. Gamblers need action to feel alive. Operators need structure to stay solvent. Darvas understood something most never learn. You are not paid for opinions. You are paid for execution under uncertainty. Risk must be defined before opportunity is considered. Position size must protect psychology, not inflate ego. The tape must confirm strength before money is committed. Without those rules, intelligence becomes a liability instead of an advantage. In the next chapter, you'll see why boredom is a professional signal, not a problem. You'll understand why most traders fail before the real move even begins. And you'll see how waiting filters out fear/greed long before it hijacks decisions and destroys accounts. The hardest thing to master in trading is patience. Not strategy. Not analysis. Patience. Amateurs feel productive when they trade constantly. Professionals feel protected when they wait deliberately. Darvas discovered this accidentally while touring across continents, trading from hotel rooms between performances. He couldn't monitor the tape constantly. Orders were delayed. Information arrived late. Instead of harming him, this limitation saved him. He noticed something uncomfortable. The more he watched prices, the worse his decisions became. Fear/greed intensified with attention. Every tick felt meaningful. Every fluctuation demanded action. That pressure created mistakes. So Darvas changed the rules. He refused to trade unless price reached a clearly defined pivotal point. No confirmation, no trade. No excitement, no entry. Weeks passed with 0 trades. Other traders bragged about daily wins and non-stop activity. Darvas stayed flat. Cash became his position. Waiting as a position removed temptation. It also revealed a truth amateurs hate. Most movement is meaningless. Most trades exist only to test your discipline. Then one stock broke out cleanly from a long range. Volume expanded. The tape spoke clearly. Price behaved exactly as his rules required. Darvas entered calmly, with small position size and predefined risk. A stop-loss was placed immediately, not emotionally, but mechanically. This is the professional protocol. You trade confirmation, not movement. Waiting as a position eliminates random losses before they occur. It filters noise before it becomes damage. It preserves psychological capital, which matters more than money early on. Pattern interrupt. Doing nothing is sometimes the best trade. Amateurs confuse activity with progress. Professionals measure progress by avoided mistakes. Darvas learned most losses occur before trends exist. They happen during impatience, boredom, and the need to feel involved. So he stopped participating early. He waited for proof instead of hope. The rule is unforgiving. If price hasn't proven itself, you are not paid to act. This mindset removed revenge trading entirely. When a trade stopped out, there was no urgency to make money back. There was only a return to waiting. Emotional urgency disappears when patience becomes policy. Waiting also sharpened execution. Because Darvas traded less, each trade mattered more. He prepared entries carefully. He respected position size. He accepted risk calmly. This created confidence that amateurs never experience because they are always reacting. But waiting alone doesn't create wealth. Execution after confirmation matters. Darvas didn't start big. He let the market earn his confidence. He allowed price to invite more risk rather than forcing exposure. This prepared him for the next discipline, one most traders misuse. Position size would become his psychological throttle. Too large, fear/greed dominates. Too small, rules are easy to follow. Darvas understood this intuitively before he could explain it. Waiting taught him restraint. Restraint taught him control. This leads directly to the next rule. How position size controls fear/greed. Why professionals think in percentages instead of profits. And why most traders sabotage themselves before real profits ever appear. This patience also changed how Darvas viewed time. He stopped measuring success in days and started measuring it in cycles. Weeks of waiting no longer felt wasted. They felt necessary. Professionals understand time is a filter. Amateurs try to compress outcomes. Darvas allowed outcomes to expand naturally. That mental shift reduced pressure. Reduced pressure improved decisions. Improved decisions preserved capital. Capital preservation created opportunity. Opportunity only appears to those still standing. Waiting trained Darvas to observe rather than interfere. He learned to let the tape speak without interruption. He learned silence has information. Most traders talk themselves into trades. Darvas listened his way out of them. That restraint prepared him for the most dangerous moment in trading. The moment when success tempts you to break your own rules. Those lessons matter because the next principle will test discipline harder than waiting, forcing you to confront position size directly, where most traders finally surrender control when fear/greed returns disguised as confidence again quickly. Most traders think emotions cause losses. Darvas knew size causes emotions. Early in his journey, he went heavy on a perfect setup that looked flawless on paper. The stock dipped slightly after entry, nothing dramatic, nothing structural. Panic replaced logic instantly. His hands froze. His mind raced. The analysis wasn't wrong at all. The position size was. That loss burned a permanent rule into his thinking. If a trade affects your sleep, your size is wrong. Professionals enter small, almost boringly small, because boredom is safety. Darvas began risking a fixed percentage per trade, often 1 to 2% of total capital. A stop loss was defined immediately, not later, not mentally, but physically placed. This wasn't caution. It was control. Amateurs try to win big fast. Professionals try to stay alive long enough for probability to work. Small position size quiets fear/greed before it can hijack decisions. Quiet minds follow rules. Loud minds break them. Darvas treated trades as information, not identity. Losses didn't insult him. Wins didn't inflate him. Each trade was a data point, nothing more. Pattern interrupt. Confidence comes from survival, not prediction. Because size was controlled, Darvas could hold through noise. He didn't micromanage price. He didn't stare at every tick. He observed the tape with detachment. When price respected structure, he stayed. When it didn't, he exited without debate. Position size allowed obedience. This also changed how Darvas perceived risk. Risk stopped being emotional and became numerical. He knew exactly how much he could lose before entering. That certainty removed hesitation. Most traders hesitate because they don't know the cost of being wrong. Darvas always knew the cost. Small size also protected him from revenge trading. After a stop loss, there was no urge to immediately recover money. The loss was already accepted. Emotional urgency disappears when damage is controlled. This is why professionals rarely spiral. They structure losses so spirals cannot begin. Another subtle effect emerged. Small size improved patience. When trades didn't matter emotionally, waiting became easier. Waiting as a position felt natural instead of painful. Darvas could sit through consolidation without inventing reasons to exit early. He could let winners breathe. This discipline quietly prepared him for the most dangerous phase of trading: success. Winning trades tempt traders to increase size impulsively. Darvas resisted that urge. He never increased size randomly. He only increased exposure when price earned it. That rule leads directly to pyramiding. Most traders pyramid emotionally, adding when excitement peaks. Darvas pyramid structurally, adding only after confirmation from the tape at a new pivotal point. But pyramiding only works if losses are already contained. Without proper position size and stop-loss discipline, pyramiding becomes disguised gambling. Darvas understood this connection deeply. Position size was the foundation. Without it, every other rule collapsed. With it, fear/greed lost its leverage. The market could no longer push him around emotionally. He was prepared to scale only when the market invited him, not when ego demanded it. He understood that size was freedom. Freedom to think clearly. Freedom to wait. Freedom to obey rules without internal resistance. When losses are small, rules feel reasonable. When losses are large, rules feel optional. Professionals never allow that choice to exist. Darvas eliminated temptation by engineering obedience. Position size became a psychological governor, limiting damage before emotion appeared. This is why most traders fail despite good strategies. They focus on entries, not exposure. They search for better signals instead of better control. Darvas reversed that priority completely, and everything else finally started working. Only then could pyramiding function safely, because the foundation was unbreakable under pressure. And this distinction will become painfully obvious in the next chapter, when Darvas begins adding to winners while amateurs self-destruct at exactly the wrong moment. Pyramiding sounds aggressive, but Darvas used it defensively. Amateurs add because they feel right, excited, and validated by short-term gains. Professionals add because price proves them right through structure and confirmation. Darvas never increased position size at entry. He waited patiently for confirmation from the tape before committing additional risk. One trade defined this rule permanently. Darvas bought a breakout with deliberately small size, almost insignificant emotionally. Price advanced cleanly, then paused, drifting sideways without damage. A new box formed, tighter than the last. He did nothing. No excitement. No prediction. Just observation. Then price broke the next pivotal point with expanding volume. Only then did he add. Each addition had its own stop-loss placed immediately. Each layer reduced emotional exposure instead of increasing it. This is the paradox amateurs never understand. As his position grew, Psychological risk actually shrank. Here is the professional protocol Darvas followed relentlessly. Initial entry is always the smallest. Add only after structure forms and confirms strength. Never add below prior support or inside congestion. If price violates structure, exit without hesitation. Amateurs pyramid hope. Professionals pyramid confirmation. Darvas never averaged down. Never once. He understood that averaging down feeds fear/greed and destroys discipline. Pattern interrupt. You don't get paid for being early, only for being right. Pyramiding allowed Darvas to ride trends for months instead of days. Most traders exit early because fear/greed demands relief and certainty. Darvas trusted the tape. As long as structure held and price respected the box, he stayed involved. This approach changed everything about his results. Small initial risk allowed patience. Patience allowed holding. Holding allowed compounding. Compounding created outsized returns from a few exceptional trades. But pyramiding only works if exits are ruthless. Without discipline, gains evaporate faster than losses. Darvas raised stop-loss levels only after new structure formed. He never widened stops to protect ego. Stops existed to protect capital and clarity. This rule separated professionals from amateurs completely. Amateurs add when emotions peak. Professionals add when emotions are quiet. Darvas added only when rules demanded action, never when excitement requested permission. Each pyramid layer was earned, not hoped for. Each addition was justified by confirmation, not confidence. This kept his average loss small and his occasional winners enormous. Darvas understood something subtle. Big money is made by staying with winners, not by finding more trades. Pyramiding was not aggression. It was obedience expressed repeatedly. This discipline prepared him for the hardest rule of all: exits. Because adding is meaningless if you cannot leave without regret. Darvas respected exits as acts of strength, not surrender. Amateurs cling because leaving feels like failure. Professionals leave because rules demand respect. Every stop-loss he executed reinforced identity. He wasn't trading to feel smart. He was trading to remain consistent. Exiting cleanly preserved emotional capital for future opportunities. He noticed traders talk endlessly about entries, rarely about exits. That imbalance destroys accounts quietly. Darvas reversed focus. He planned exits before entries. He accepted that being wrong was normal, even necessary. Losses were expected costs, not personal verdicts. This mindset prevented regret. Regret leads to revenge. Revenge leads to impulsive trades. Impulsive trades break position size discipline. The spiral always begins at exits. Darvas stopped the spiral before it formed. Each time price violated structure, he exited instantly. No hope. No reinterpretation. The tape was the final authority. That obedience created trust in his process. Trust allowed patience. Patience allowed waiting as a position again. Everything connected. Pyramiding depended on exits. Exits depended on size. Size depended on patience. Patience depended on waiting. Waiting depended on discipline. Discipline depended on identity. That identity is what amateurs never build. They trade to feel something. Darvas traded to remove feeling entirely. This endures. Most traders say they use stop-loss. Darvas respected it absolutely, without exception or interpretation. Early on, he broke his own rule once, and that mistake reshaped everything. Price dipped slightly below the box, just enough to trigger discomfort. He hesitated. It will come back, he thought. It didn't. That single exception erased weeks of steady progress and something more valuable than money. It erased trust in himself. From that moment forward, Darvas treated stop-loss as law. If hit, he exited immediately. No negotiation. No reinterpretation. No second chances. The professional rule became non-negotiable. Your stop-loss marks the precise point where your idea is invalid. If price reaches that point, the idea is wrong. Amateurs argue with price. Professionals obey it. Darvas placed stops the moment he entered, before emotion had a voice. He did not wait to see how price felt. He did not adjust stops to protect ego. Position size made this possible. Losses were tolerable by design. Ego stayed quiet because damage was controlled. When loss is small, obedience is easy. When loss is large, rules feel optional. Darvas never allowed that choice. Pattern interrupt. Small losses are tuition, not punishment. This discipline created mental clarity most traders never experience. There was no regret after exits. No hesitation before entries. Losses became data, not drama. Wins became trends, not trophies. Because exits were predefined, Darvas could focus entirely on execution rather than emotional management. But exits weren't only defensive. They were strategic. Darvas didn't trail stops randomly or emotionally. He raised them only after structure formed and price earned protection. Stops followed logic, not fear. If price built a new box, the stop moved. If structure held, the trade stayed alive. If structure failed, the trade ended cleanly. This rule protected him from the most dangerous illusion in trading: hope. Hope disguises itself as patience. Real patience obeys rules. Darvas never confused the two. He understood patience means waiting for confirmation, not ignoring invalidation. When the tape spoke against him, he listened. This approach reinforced identity. Each disciplined exit strengthened trust in the system. Trust reduced hesitation. Reduced hesitation improved execution. Execution preserved capital. Capital preserved opportunity. The loop was self-reinforcing. Amateurs view exits as failure. Professionals view exits as maintenance. Darvas exited proudly when rules demanded it. There was no emotional residue. No revenge trades. No desperate re-entries. After a stop-loss, he returned to waiting as a position. Calm replaced urgency. This also solved a deeper psychological problem. Most traders fear being wrong. Darvas accepted being wrong as routine. Wrong didn't threaten identity because identity wasn't attached to outcomes. It was attached to process. The stop-loss protected that process. Over time, Darvas noticed something profound. The market punished stubbornness more consistently than ignorance. You can survive ignorance with discipline. You cannot survive ego without damage. Stops were ego control devices. This discipline prepared him for the next evolution. Structure. Stops needed reference points. Those reference points became boxes. Boxes replaced prediction entirely. Price behavior defined action. The box wasn't a pattern to trade. It was a psychological boundary to enforce discipline. That distinction matters. Most traders try to predict breakouts. Darvas waited for them. Most traders draw lines hoping price respects them. Darvas used structure to decide when he was wrong. This inverted relationship removed emotional interpretation completely. In the next stage, you'll see how structure replaced prediction entirely. How the box became a behavioral contract between Darvas and the market. And why professionals don't need forecasts when they have rules that enforce truth consistently. Structure gave Darvas certainty without prediction. It told him when to act, wait, add, or exit. That clarity removed emotional bargaining entirely. Once structure governed decisions, consistency followed naturally. Professionals seek rules that remove choice. Amateurs seek freedom and lose control. Structure ended debate forever. That is why his discipline scaled under pressure repeatedly without emotional leakage. Most traders see the Darvas box as a chart pattern. That's amateur thinking. The box was never about price prediction. It was about behavior containment. Darvas noticed something subtle while reviewing his winning trades. Strong stocks didn't move randomly. They paused before advancing. They respected ranges. They punished impatience. Weak stocks behaved differently. They chopped violently. They tempted early entries. They exhausted discipline. So Darvas drew boxes to define acceptable behavior. Inside the box, he waited. Above the box, he acted. Below the box, he exited without debate. The box wasn't a signal. It was a contract. A contract between him and the market that removed interpretation. Professional protocol was simple and unforgiving. Price must behave before it pays you. The box removed prediction entirely. It replaced opinion with boundaries. Pattern interrupt. Structure beats opinion every time. Amateurs anticipate breakouts because anticipation feels intelligent. Professionals wait for confirmation because confirmation pays. Darvas didn't care why a stock moved. He didn't study stories, news, or explanations. He cared how it moved. Did it respect structure? Did it hold ranges? Did it advance without emotional volatility? Boxes also controlled emotion. They removed impulse. They defined action points in advance. When price was inside the box, there was nothing to do. That eliminated boredom-driven trades. When price broke above, action was required. When price fell below, exit was mandatory. No gray areas. No emotional debate. This clarity did something powerful. It eliminated internal conflict. Most traders fight themselves more than the market. Darvas removed that fight. The box decided for him. But boxes alone don't create wealth. Mindset does. The box worked because Darvas had already built discipline around risk, position size, stop loss, and patience. The box simply enforced what his psychology had already accepted. That mindset was built around process, not outcomes. This is the core psychological difference most traders never resolve. Amateurs obsess over results. Professionals obsess over execution. Amateurs ask, "Did I make money?" Professionals ask, "Did I follow rules?" Darvas measured success by obedience, not profit. One trade illustrates this perfectly. Darvas held a stock that had already doubled. Fear/greed tempted him to lock in gains. Price moved sideways inside the box for weeks. Nothing happened. Many traders would exit out of boredom. Darvas stayed. The box held. When price finally broke higher, he added through pyramiding. That trade became one of his largest winners. The box trained patience automatically. It forced waiting as a position. It prevented premature exits. It also prevented false confidence. When price broke below the box, Darvas exited even profitable trades. He didn't care how much he was up. Structure mattered more than P&L. This rule crushed ego. Ego wants credit. Structure demands obedience. Darvas chose obedience. Over time, this rewired his identity. He no longer felt smart for predicting. He felt professional for executing. The box also aligned perfectly with position size discipline. Because entries were defined, size could be controlled precisely. Because exits were predefined, risk was always known. Because pyramiding occurred only after new boxes formed, exposure grew logically. Everything connected seamlessly. Amateurs draw boxes to feel technical. Professionals use boxes to remove choice. Choice is dangerous under pressure. Darvas engineered his environment so the correct action was obvious. When decisions are obvious, mistakes decrease. This is why his system scaled under stress. There was no improvisation. No emotional creativity. Only repetition of rules. That repetition created consistency. Consistency created confidence. Confidence allowed patience. Patience allowed waiting. Waiting allowed only the best trades to survive. Boxes transformed uncertainty into manageable behavior. They didn't predict the future. They controlled response. Darvas understood you cannot control outcomes, but you can control reactions. The box controlled reactions perfectly. Which brings us to the deepest psychological shift of all. Why professionals detach from outcomes entirely. Why execution becomes identity. And why boredom, obedience, and repetition are not weaknesses, but the hidden strengths behind every long-term trading career. Amateurs watch P&L like a heartbeat monitor. Professionals watch behavior like a risk manager. Darvas made this shift after realizing profits distorted judgment. Early on, he checked gains obsessively. Every uptick felt validating. Every pullback felt threatening. The market controlled his mood. That had to stop. One trade forced the change. Darvas was holding a strong breakout, already up significantly. Then price pulled back sharply toward the top of the box. Fear surged instantly. His P&L shrank. Greed whispered to protect gains. Panic suggested exit. But something was different this time. The tape stayed calm. Volume dried up. Price respected structure. The box held perfectly. Darvas did nothing. He treated waiting as a position. Days passed. Then price resumed higher, breaking into a new range. That single trade became one of his largest winners, not because of analysis, but because of restraint. Professional rule: if structure holds, your opinion doesn't matter. The market does not pay you for emotional reactions. It pays you for correct responses to behavior. Process thinking reduced emotional interference. Outcome obsession amplified it. Darvas stopped asking, "Am I making money today?" He started asking, "Did I follow the protocol today?" This shift was subtle, but transformative. Pattern interrupt: the market pays consistency, not intensity. Amateurs seek emotional certainty. Professionals accept uncertainty and manage risk instead. Darvas accepted that individual trades were meaningless. Only the series mattered. This reframed losses. A stopped-out trade wasn't failure. It was execution. A profitable trade that violated rules wasn't success. It was dangerous reinforcement. This mindset detached him from fear/greed. Emotional swings flattened. Decision quality improved. Durability increased. He could trade longer, think clearer, and wait patiently for confirmation. But process thinking requires trust. Trust is not belief. Trust is earned through repetition. Darvas didn't wake up disciplined. He built discipline by following rules when it was uncomfortable, especially when boredom appeared. Boredom is where most traders break. When nothing happens, amateurs invent trades. They change position size. They lower standards. They chase movement without confirmation. Professionals recognize boredom as a signal that no edge is present. Darvas embraced boredom deliberately. Touring as a dancer forced inactivity. He couldn't monitor every tick. Ironically, this separation protected him. Less exposure to noise reduced impulsive decisions. He learned that constant engagement damages objectivity. Professional protocol: boredom means conditions are not aligned. If price hasn't reached a pivotal point, you are not required to act. Waiting as a position preserves capital and mental clarity. This also protected pyramiding discipline. By waiting for new boxes to form, Darvas added only when the market invited him. He never forced exposure. Each addition was earned by structure, not emotion. Amateurs feel behind when they're inactive. Professionals feel safe. Darvas understood that most damage occurs between good trades, not during them. He avoided that damage by staying flat unless conditions demanded action. Another subtle benefit emerged. Process focus neutralized ego. Wins didn't inflate confidence. Losses didn't erode it. His identity wasn't tied to being right. It was tied to being consistent. That consistency made risk predictable. Predictable risk allowed larger opportunity capture over time. This is where most traders fail psychologically. They want excitement. Markets reward patience. They want action. Markets reward restraint. Darvas aligned himself with how markets actually function, not how they feel. But boredom is only an advantage if exits are respected and patience is enforced. Otherwise, inactivity becomes procrastination. Darvas avoided that trap through one final discipline. A discipline that unified risk, patience, pyramiding, stop-loss, and confirmation into a single operating framework. Next, you'll see how Darvas built unshakable trust in his system. And why trusting the process matters more than trusting yourself. Most traders quit because trading feels boring. Darvas leaned into that boredom deliberately. He realized excitement was not a feature of profitability. It was a warning sign. Excitement meant ego was engaged. Ego distorted risk perception. Boredom, by contrast, meant rules were intact. There were long stretches when Darvas placed no trades at all. Weeks passed. Markets moved. Stories circulated. Other traders bragged about activity. Darvas stayed flat. Not because he was afraid, but because nothing had reached a pivotal point. No confirmation from the tape meant no obligation to act. Amateurs need stimulation to feel productive. Professionals need alignment to stay solvent. Darvas understood that most losses don't come from bad analysis. They come from unnecessary trades. Trades taken out of impatience. Trades taken to relieve boredom. Pattern interrupt. Boredom is a signal you're doing it right. One specific period reinforced this lesson. Darvas was watching several stocks drifting sideways. Minor fluctuations tempted him. He felt the urge to get involved early. Instead, he wrote a rule on paper: if price hasn't escaped the box with volume, I do nothing. Days later, 2 of those stocks broke down sharply. By waiting, he avoided losses he never had to manage. Professional rule: if nothing meets your criteria, you do nothing. Waiting as a position is not passive. It is active defense. Boredom also protected Darvas from overtrading. Overtrading is rarely dramatic. It erodes accounts quietly. Small losses. Increased commissions. Emotional fatigue. Gradual loss of confidence. Darvas avoided this by drastically limiting decisions. Fewer decisions meant higher quality decisions. Amateurs believe more trades equal more opportunity. Professionals know opportunity is rare. Darvas treated opportunity like a visitor. If it didn't knock clearly, he didn't answer the door. This patience preserved capital. More importantly, it preserved confidence. Confidence doesn't come from constant winning. It comes from knowing losses are controlled. When you haven't damaged yourself through boredom trades, you're mentally prepared when real opportunity appears. And when opportunity finally appeared, Darvas was ready. He didn't hesitate. He didn't second guess. Because he hadn't exhausted himself emotionally beforehand. Boredom created sharpness. Another subtle effect emerged. By trading less, Darvas saw patterns more clearly. Noise faded. Structure stood out. He wasn't distracted by constant positions. The tape became easier to read. Confirmation became obvious, not ambiguous. Amateurs ask, why am I not in this move? Professionals ask, does this fit my rules? Darvas answered only the second question. That discipline compounded over time. Boredom also reinforced proper position size. When you trade rarely, you respect risk more deeply. You don't feel compelled to increase size out of frustration. Each trade feels important, but not desperate. Darvas kept risk consistent, even after long inactive periods. This prevented emotional spikes. Fear/greed stayed muted. His identity shifted further from outcome dependence. He wasn't a trader who needed action. He was an operator who executed when conditions aligned. By embracing boredom, Darvas built the foundation for scalability. He could manage larger capital without increasing stress. The same rules applied. The same patience. The same waiting. This is where many traders fail to integrate the system. They understand individual rules, but not how they reinforce each other. Patience protects risk. Risk enables pyramiding. Pyramiding magnifies trends. Trends reward confirmation. Confirmation reduces emotional interference. Darvas didn't see these as separate techniques. He saw them as one operating system. Boredom was the glue that held it together. Because boredom kept him from interfering, from tinkering, from breaking rules during quiet periods. It ensured that when action came, it was clean. And that leads to the final integration. The complete Darvas mindset. How all these rules lock together into one professional framework. And why mastering this framework matters more than mastering any setup. Darvas didn't trade tactics. He operated a system. That distinction explains everything that came before. Waiting as a position filtered noise before it reached his emotions. Position size controlled fear/greed before it influenced decisions. Stop loss protected capital before damage became psychological. Pyramiding maximized trends without increasing emotional risk. Boxes enforced discipline without prediction. The tape replaced opinion entirely. Each rule existed to protect another rule. Remove one, and the system collapses. Amateurs cherry-pick what feels comfortable. They like pyramiding but ignore stop-loss. They like waiting but abandon position size. Professionals understand systems only work when followed completely. Darvas learned this the hard way. Early success tempted him to relax rules. One winning streak made him feel smarter. He widened stops slightly. He added faster than structure allowed. The market punished him immediately. Gains evaporated. Confidence cracked. That regression reminded him the system was unforgiving for a reason. Professional rule: systems don't adapt to your emotions. You adapt to the system. This system wasn't complex. There were no indicators stacked on indicators. No predictions. No opinions about news. Its power came from consistency. From repetition. From obedience under boredom and pressure alike. Pattern interrupt. Simplicity is harder than complexity. Darvas understood that complexity creates excuses. Excuses create rule-breaking. Rule-breaking creates inconsistency. Inconsistency destroys expectancy. His system removed excuses entirely. Price either confirmed or it didn't. Structure either held or it didn't. Risk was either defined or it wasn't. Amateurs seek flexibility. Professionals seek clarity. Another anecdote sealed this understanding. Darvas watched a stock surge dramatically without him. It broke out while he was flat. Amateurs would chase. He didn't. The breakout lacked volume confirmation. The tape was erratic. Days later, the stock collapsed. By missing a move, he avoided a loss. That reinforced his belief that systems protect you from what you don't see. Professional takeaway: missing trades is part of profitability. This mindset shifted how Darvas measured success. Not by profit spikes. By how cleanly he executed rules. A good month wasn't defined by dollars. It was defined by discipline adherence. This reframing reduced pressure. Reduced urgency. Reduced emotional fatigue. Fear/greed thrive in ambiguity. Systems eliminate ambiguity. Darvas stopped identifying as a trader chasing opportunity. He became an operator executing conditions. That identity shift mattered. Operators don't argue with machines. They follow procedures. The market became a machine responding to behavior, not stories. This system also solved scalability. As capital grew, stress didn't. Position size rules scaled automatically. Risk remained constant as a percentage. Pyramiding added exposure only when the market paid for it. Waiting as a position prevented forced activity. Growth became smoother. Amateurs blow up when size increases. Professionals design systems that absorb size. Darvas never asked, "What do I feel like doing today?" He asked, "What does the system require?" That question neutralized ego. Ego causes traders to override stops, chase breakouts, and abandon patience. His system starved ego. Tape reading replaced interpretation. Boxes replaced hope. Stops replaced denial. Waiting replaced compulsion. Each element reinforced the others. This is why the Darvas method still works decades later. Not because of chart patterns, but because of human behavior. Markets change. Psychology doesn't. Most traders fail because they look for a missing rule. Darvas succeeded because he followed all of them together. Consistently. Relentlessly. That's why amateurs copy techniques and still lose. They never adopt the operating system. Professionals know the system is the edge. And now the final loop closes. The hidden rule teased at the beginning was never a tactic. It was a mindset. A way of operating under uncertainty without self-destruction. In the final chapter, you'll see the complete Darvas mindset framework revealed plainly. How all rules collapse into one discipline. And how you apply it without modifying a single part. Darvas wasn't special. His discipline was. That's the final truth most traders resist. He didn't have superior intelligence. He didn't predict markets better. He didn't eliminate uncertainty. He accepted it fully and built rules around it. Early in his career, uncertainty terrified him. Every open position felt like a question mark. Price movement felt personal. Over time, he reframed uncertainty as a constant, not a problem. Markets are uncertain by nature. Professionals don't fight that. They design systems that survive it. Darvas respected risk above everything. Risk wasn't something to overcome. It was something to manage precisely. Every trade began with defining where he was wrong. The stop loss came first. Not later. Not mentally. Immediately. That single habit separated amateur hope from professional clarity. He trusted process more than outcomes. One trade proved this permanently. After a long winning streak, he took a textbook setup that failed instantly. Stop hit. Small loss. Emotionally, it felt unfair. Structurally, it was perfect execution. He logged it as a success. That decision marked full professional maturity. Professional rule: your job is not to win trades. Your job is to execute rules under uncertainty. Darvas didn't confuse confidence with certainty. Confidence came from repetition. From following the same protocol regardless of recent results. Position size stayed consistent. Fear/greed stayed muted. The tape dictated action, not emotion. Pattern interrupt. Discipline feels restrictive until you realize it creates freedom. Boxes weren't cages. They were boundaries that freed him from impulsive decisions. Waiting as a position wasn't passivity. It was capital protection. Pyramiding wasn't aggression. It was permission earned from the market. Each rule reduced decision fatigue. Fewer decisions meant fewer mistakes. Amateurs constantly ask, "What should I do now?" Professionals already know the answer. If conditions aren't met, they do nothing. If conditions are met, they execute without hesitation. Darvas never chased excitement. He avoided it. Excitement signaled emotional involvement. Emotional involvement corrupted judgment. He preferred boredom. Boredom meant alignment. Alignment meant clarity. Another subtle discipline mattered deeply. Darvas separated self-worth from outcomes. A losing trade didn't mean he was wrong as a person. A winning trade didn't mean he was brilliant. This emotional neutrality preserved longevity. Most traders burn out psychologically before they run out of capital. Professional takeaway: survival is the prerequisite for success. The Darvas mindset framework is simple but unforgiving. Define risk first. Control position size. Demand confirmation from the tape. Act only at pivotal points. Pyramid only when structure proves strength. Exit immediately when structure breaks. Spend most of your time waiting. Every component supports the others. Remove patience, and risk expands. Remove stops, and pyramiding becomes gambling. Remove position size control, and fear/greed hijacks decisions. Remove waiting, and overtrading destroys expectancy. This framework doesn't promise excitement. It promises durability. It doesn't promise constant action. It promises consistency. Darvas didn't seek thrills. He sought repeatability. That's why his success wasn't a lucky streak. It was an inevitable outcome of disciplined behavior repeated under uncertainty. Anyone can learn tactics. Few adopt discipline fully. The market doesn't reward intelligence. It rewards behavior. Darvas aligned his behavior with how markets actually function. That alignment compounded over time. This is the real secret rules that made Darvas millions. Not a box. Not a breakout. Not a trick. A mindset built to survive long enough to let trends pay. Cut losses fast, size small, weight, own the process. If you learned how structure creates freedom, the next lesson on holding winners without fear will deepen it.